Hey Warriors, I hope you're all doing good. I know the exams are around the corner, and so ICA is also playing its part well. Last week, ICA released the RTPs, the revision test papers for CA Inter and CA Final May 2024 exams. This time's RTPs are quite interesting and exciting, at least to my personal opinion, and therefore I'm shooting this short video to discuss this RTP along with you, right? Until last year, RTPs used to come in all this black and white format and everything. It was never exciting to read this RTPs, but this time's RTP looks all color, the fancy green colors and everything has been put. So quite of exciting thing. But yes, beyond the fancy things which you see, questions this time are actually very exciting. This time ICA has played a very nice role in putting some good questions relating to your amendments of the current year, and so therefore this MCQs and the questions which are given becomes very crucial for you to practice for your exams. Keeping the thought in mind is what I wanted to do this short video with you. Now in this video I'm obviously not going to be discussing the descriptive questions along with you, because the answers to the descriptive questions along with the reasoning are already there, so there's no point of you wasting time along with me here. My intention is very simple. What you're going to do in this RTP is that you're going to take this RTP, you're going to solve it as if this is your exam paper, right? Without looking at the answers, just by looking at the questions, you're going to evaluate your performance. Don't keep any time limits and all, it's completely fine. I just want to see how your technical soundness is. So you're going to take this RTP, you're going to solve this RTP on your own and see how much marks are you getting in this RTP. Now, while there are no marks in this RTP, you are smart enough right now to understand how much marks will a question weigh. So you will put your own marks and do a self-evaluation. The intention is very simple. At this point of time, you have a strong grip on your concepts. The only thing which is pending is a practical application of it, and these questions will beautifully help you understand those, right? So you're going to sit and solve all those questions, see where you weigh, and then come back to this video. In this video, what we're going to do is we are going to look at the MCQs. Now, the reasoning, the answers for the MCQs are also given in this RTP, but the problem is the reasonings are not given, and therefore some of you may have a concern as to how Rahul this answer came and are not be able to find it out. For that is what this video is. We're going to solve the MCQs, understand the reasoning behind it, put all the steps around, so that tomorrow when you solve it and you don't get a right answer, you're able to understand the reasoning to it. That is what the plain intention is. There are some issues in this also which we are going to discuss. That is what this video is about. Yes. So once again clarifying to you, not doing descriptive in this video, only doing the MCQs. Do not come and look at the video unless and until you have solved the RTP yourself. Please close the video right now. If you are that shameless person who has not solved the RTP yourself, come back to me. Don't get offended. Please come back to me later on once you have solved the RTP yourself and you have a certain amount of confidence on what the subject looks like. Yes, keeping that in mind is what we're going to solve the MCQs right now. Now here there is about 8 MCQs which we are going to solve along with the case study question. So let's focus on those. We are first going to look at the case study question. Now I know all my warriors would come and say me, Rahul, you only tell me never to start with case studies. Hey, I am discussing, so I can do whatever I want. I know the subject properly and I don't have a time limit restriction and all. So we will solve from the case study level only. When you're doing it as an exam question, please don't solve the case study first. You'll be wasting too much time on it. Okay. Anyway, let's start today's class. We're going to the case study. Now, I'm going to follow the format of exam, obviously. Even though I'm starting with case study, I'm going to follow the format, which means I'm going to ignore the storyline which is given and I'm going to ask the questions first. I'm going to look at the questions first. It's starting here. It says, what are the life insurance policies in respect of which Mr. Akash should be eligible for exemptions? So the first question itself is an amendment question of the current year. They're going to try to ask you, Rahul, tell me what are the policies which are going to be exempt under 1010D. First amendment question of the current. Okay, great. Second, they're coming and saying, what would be your answer to MCQ number 1 if Akash surrendered LIC A in 67 and 26 and 27 and claimed exemption under section 1010D in respect of such LIC? Which means second question is also LIC related question, which means there is something exciting about the amendment which is going to come. Let's look at it later. Question number 3, what would be the amount of deduction which is eligible to Mr. Akash? What would be the amount of deduction which is eligible to Mr. Akash under chapter 6A if he has exercised the option of shifting out of default regime? Which means question number 3 is talking about chapter 6A deductions. Let's focus on all the deductions which come in the question. Question number 4. What is Mr. Akash's tax liability for 24-25 under default tax regime? So tax liability default regime. Now notice question number 3 asked you for chapter 6A opting out of default regime. Question number 4 is asking you to again come back to default regime and compute tax, which means you need to do both the regimes, mandatory. Question number 5, what will be the tax liability of 24-25 if he has exercised the option of shifting out? Again, so they're telling you, Rahul, do opting in, do opting out, find out tax for both. If I do two different questions. And yes, then question number 6 starts with a separate question, so we'll ignore that. Let's come back to the case study now. We'll read the case study as if you're going to read it for exam, and we're going to ask ourselves, Rahul, which of the points are relevant, which of the points are not relevant. Let's proceed. It says, Mr. Akash is age 47 years, which means the person is a normal citizen, normal slab rates, no problem. He's a CEO of BSc Limited, which means the person is going to be a salaried person. During the previous year 23-24, he's earned the following incomes. They've given you the incomes right away off the bat. First income is salary of 45 lakhs. Taxable under the head salaries, obviously. But the problem is not that. The problem is that you are eligible for standard deduction, and therefore this amount will become 44 lakh 50,000. 44 lakh 50,000. Now you'll come and ask me, Rahul, nothing is given. It just says salary. It's not even saying computed, not computed and all. You can put your own assumptions. My assumption is this is 44 lakh 50,000. My assumption is this is 44 lakh 50,000 because the word computed is not given. It is saying he has earned this. He has earned this, which means this is the gross. Next. Long-term capital gains on sale of listed equity shares is 6,54,000. They are coming and telling that, Rahul, now you have a 11A, which is going to be taxable at the rate of 15%. Okay. Next, they are saying, Rahul, there is a dividend of 12 lakhs from shares of Indian company. There is a dividend of 12 lakhs from shares of Indian company, and therefore you are going to have again a slab rate income. 12 lakh rupees. Next, you have an interest on savings account with SBI 16,000. So you're again going to have a slab rate income of 16,000 rupees. But because this is a savings account and it's an SBI, you are also eligible for a Chapter 6A deduction, which is 80 TTA. I'm going to put it in a different color because it is not a part of default regime. It is only a part of alternate regime. Rahul, salary is 50,000. Current year amendment will be eligible in both the regimes. So 80 TTA number will become 10,000 rupees. We'll answer that separately. Yes. Next, interest on fixed deposit with BOB of 45,000. Again a slab rate income. So you have a slab rate income of 45,000 rupees. Since the person is 47 years, he is not eligible for 80 TTB, and therefore there is no further deductions to be granted. This is what your incomes are. Let's see the next page and see if there is any other incomes before we make some conclusions. Mr. Akash has made the following payments towards medical insurance. So he's made payments towards medical insurance. We are looking at section number 80D. So they're coming and saying, Rahul, they've made the following health insurance policy payments for his family members. For spouse, he has made a 13,500 worth of payment. Spouse is a part of your bucket, and therefore 13,500 eligible for deduction. For mother, he has paid a payment of 26,670. Rahul, can you claim the whole payment? Answer is yes, because the mother is a senior citizen. It says the age is 65 years, and therefore she is eligible for 50,000 worth of bracket. So I'll put the whole 26,670. Next, preventive health checkup, which you have paid for 5,500 each, so for his wife and his mother in cash. Now I've paid preventive health checkup 5,500 each. Rahul, can you claim both? Answer is no. How much can you claim, Rahul? For all people put together, you can maximum claim 5,000. Rahul, payment in cash is permitted. Answer is yes. Preventive health checkup, payments of cash is also permitted. So 5,000 you can claim as deduction. Now Rahul, which person will claim the deduction? Will the mother claim it or will the spouse bucket claim it? We will discuss later. Let's read the whole question before we make conclusions. Next, Mr. Akash also incurred medical expenses by credit card of 17,000 for the treatment of his mother. Notice very carefully. Same mother, you took insurance. Same mother, you're paying expenditure. Can you claim? Answer is no. Income tax comes and says that, Rahul, if you've already claimed insurance, you cannot claim any expenditures. So no deductions for him, for her. Next, he has also paid 27,000 by credit card for his father, who's 67 years old. Now, if you notice on the top, nowhere father has been mentioned, which means father is a senior citizen. They have incurred medical expenditures for it. Can you claim it? Answer is yes. Because father ka nothing is given. Assumption is there is no insurance for him. Now, income tax comes and says, Rahul, when there is a bucket format for 80D, which is self, spouse and children in one bucket, parents are in another bucket, because one of the parent is senior citizen, that bucket will get overall 50,000. Let's check the mother and the father together. Mother is 26,670. Father is 27,000. If I total the number, it comes as 53,670. Can I claim 53,670? Answer is no. Because that bucket can only claim maximum 50,000 rupees. So what I'm going to do is I'm going to delete this 26,670 and I'm going to put it as 50,000. Maximum you can claim 50,000 rupees. Yes. Now, When you have already exhausted the bucket of parents, can you claim the preventive health checkup in the parents? Answer is no. So therefore, you'll automatically move it to the spouse bucket. You'll move it to the spouse bucket. So the number will become 18,500. Number will become 18,500, which means the overall ATD which you can claim is 68,500. The overall ATD which you can claim is 68,500. Clear? Yes. Let's proceed. He has multiple life insurance policies. Now comes the question number 1 and question number 2. They're saying they have multiple life insurance policies. The details of such policies are given to you as under. Notice the policies very carefully. They're saying there is 5 policies: X, Y, Z, A and B. X, Y, Z, A and B, and surprisingly in B they have come and said term insurance policy. Now what is term insurance policy, Rahul? Term insurance policy means that policy which you have paid without any returns, which means in this policy you will pay a premium. If you pass away, the sum assured will be given off to the legal heirs, but if you don't pass away, whatever money you paid is a permanent loss. It's a permanent loss. You will never get it back. Unlike the normal LIPs where you make the payment, you will get back the money if you don't pass away. Term insurance policies, you will not get anything back. Which means, Rahul, will term insurance policies ever be taxable under this amendment of current year? Answer is no. When there is no maturity itself, there is no intention of you having any kind of taxability on this. So point number B, I can directly come and say not taxable. Point number B, I can directly come and say not taxable. There is nothing which is taxable about B. Now we have 4 policies to think about. We have X, Y, Z and A. Looking at X, the date of issue is 2017. Looking at Y, it is 24. Looking at Z, it is 25. And looking at A, it is 24. So these are the policies of issuance. Now notice the policies very carefully. 3 of the policies are after 2023 and 1 policy is before 2023. Yes. What is the amendment of the current year, Rahul? The amendment of the current year comes and says is, if you are going to take a policy which is starting from 1st April 23, if you're going to take any policy which is starting from 1st April 23, there are some different guidelines, which means any policy taken before 2023, what will be the implications, Rahul? The implications are as follows. If the policy was taken after 2012, you have to assure that the premium paid is not more than 10% of sum assured. If you can ensure that the premium paid is not more than 10% of the sum assured, the policy automatically becomes exempt. Let's look at X. The premium which you have paid is 40,000 rupees is what the question comes and says. You also have GST, you also have total premium paid. Now CBDT circular comes and clearly clarifies that when you're talking about premium, it is only excluding GST. So I will ignore the GST component and I will also ignore the total premium component because I'm only bothered about the payment without GST. I'm only bothered about the payment without GST. I'm looking at annual payment which is 40,000 rupees. This 40,000 rupees, if I come down, I have the date of maturity, the consideration received and the sum assured, which means if you notice sum assured is 5 lakh rupees, you could have paid 10% of it as premium, which is 50,000 rupees. Since I've only paid 40,000 rupees, the policy automatically becomes not taxable. I hope everyone is with me till now because this is what is critical. Can we proceed? Yes. Let's look at the balance policies. You have Y, Z and A. 2 of the policies were issued in 2024 and Z was issued in 2025. Now, Rahul, what is the amendment of the current year? The amendment of the current year comes and says that if a policy's premium is going to go beyond 5 lakh rupees, the policy becomes automatically taxable. Forget 10%, forget everything else. Policy will automatically become taxable if the policy premium is more than 5 lakh rupees. Let's look at the policy premiums. In first scenario, it is 3 lakh rupees. In second scenario, it is 2 lakh. And for third scenario, it is 2 lakh 50, which means policies are not going beyond 5 lakh rupees. No problem till now. But amendment also continues to come and say, if there is no single policy which is going beyond 5 lakh rupees, but there are multiple policies, and the policy is designed in such a way that any one of the years over the period of the policies, the policy premium goes beyond 5 lakh rupees, then in that case also the policies will become taxable. So the policies which are multiple policies, if the sum together does not exceed 5 lakh rupees, then there is no problem. But if the sum together exceeds 5 lakh rupees in any 1 year also, the policy will become taxable. Now Rahul, will all policies become taxable? No. Income tax says you have to make a choice. Prepare a combination in such a way that the premiums does not exceed 5 lakh rupees and those policies you can exempt for yourself. Prepare a combination in such a way that the premium does not exceed 5 lakh rupees in any of the total policies, and that policies will become exempt. Yes, keeping that in mind, let's read it once again. you have a policy which is started on 24 and A also in 24. A also in 24. Add both the policies together. 3 lakh plus 2 lakh 50 becomes 5 lakh 50, which means right off the bat 2024 itself you have a premium more than 5 lakh rupees. Policy number Y and A together will become taxable. Coming to Z. Z was in 2025. So 2024 it was not there, but in 2025 when you paid the premium of Z, you also paid premium for X and A. You also paid premium for X and A. So which means in 2025 you actually ended up paying premium for all the three. Together number is 3 plus 2, 5 plus 2 is 7 lakh 50. Again it is going beyond 5 lakhs, which means all the three policies are now taxable. All three policies are now taxable. But like I said, because all the three policies are together becoming taxable, income tax now gives you an option where it comes and says you can make a choice, my child, and decide which policies you want to exempt, provided the premium on these policies do not exceed 5 lakh rupees. Yes, let's look at the policies. If can I make a combination where the premium does not exceed 5 lakh rupees? Can I make a combination of Y and A? Answer is no, because the total is 5 lakh 50, which means I have two options now. I can either make a combination of Y and Y and Z. I can make a combination of Y and Z because it is totally 5 lakh rupees, or I can do a combination of Z and A. I can do a combination of Z and A. Yes, I have my choice. I have my choice. Now, Rahul, which one will you prefer? Common sense. If the premium is going to be 5 lakh rupees, I will try to exhaust the whole 5 lakh. I'll try to exhaust the whole 5 lakhs, and the best combination to do that is X, Y and Z. The best combination to do that is Y and Z. So I'm going to come and say, you know what, let's make Y and Z as exempt. Let's make Y and Z as exempt. Now Rahul, because I've made Y and Z as exempt, automatically A becomes taxable. Automatically A becomes taxable. I hope you are with me here. Yes, I have chosen the policies in such a way that the total premium is not exceeding 5 lakh rupees, and I've made those policies as exempt so that I can take the balance as a credit. I can take the balance as a credit. Yes, can we proceed? Can we proceed? Yes, Polam. Let's go. Let's go. We are now looking at the total. What are the life insurance policies in respect of which Akash would be eligible for exemption in respect of maturity proceeds? Read the line very carefully. They're saying, Rahul, I want only those policies which are going to be exempt based on maturity, which means B will not even be considered. B will not even be considered because B is not even maturing. B is not even maturing. So you'll only talk about the first four policies, which is X, Y, Z and A. Now in this we have already categorized and we have come and clarified. X, Y and Z will become non-taxable, A will become taxable. So the answer automatically becomes point number A. The answer automatically becomes point number A. Yes. Question number 2. What would be your answer to MCQ number 1 if Akash had surrendered LIC A in 26-27 and then had claimed an exemption under 1010D in respect of such LIC? Which means now they're coming and saying, Rahul, you know what? I did not wait for maturity of A. I did not wait for maturity of A. Before even A matured, I came and told that I want to redeem it, and when I redeemed it, I called it as exempt. I called it as exempt. So I've come to a scenario where I'm coming and saying, you know what, Rahul, let's make this as exempt here itself. Now, the problem with this is the moment I treated A as exempt, I've already exhausted 2,50,000 worth of premium. I've already exhausted 2,50,000 worth of premium, which means I still have only 2,50,000 more to claim. I still have 2,50,000 more to claim. I can claim that either from Y or from Z. Can I claim it from Y? No, because what will happen? Y, if I claim, that will become 5,50,000. That will become 5,50,000. So Y cannot be claimed now, which means Y automatically becomes taxable. Y automatically becomes taxable. Can I claim Z, Rahul? Yes, because Z with A will become 4,50,000. Z with A will become 4,50,000, which means what will you do is, in this second scenario, what will happen is X will continue to be non-taxable because it was non-taxable earlier also. Since A has become non-taxable right now, Y will become taxable and Z will continue to be non-taxable. Z will continue to be non-taxable, which means the answer to question number 2 will become X, Z and A. The answer to question number 2 will become X, Z and A. Yes? Sweet. What would be the amount of deduction which is eligible to Mr. Akash? Yes. Let's look at the deductions. In the first scenario, in the first page, I found a deduction of 10,000 of 80 TTA. In second, I found a deduction of 8 TD, 68,500. Rahul, is this enough? No. No. Please understand, you also have paid some life insurance policies. You also have paid some life insurance policies, which means you are eligible for ATC. You are eligible for ATC. Please keep that in mind. One mistake which most of the people would have made is that they would have forgotten the ATC part. Please understand, if you pay a life insurance policy premium, you are eligible for ATC. Now the problem is a little bit different. Let's understand this carefully. Look at the date of issuance. You have 5 policies in which 3 of the policies are starting from 2024. 3 of the policies are starting from 2024. It's 2024 and later, and you are doing exam for previous year 23-24, which means technically for your exams in the previous year 23-24, which policies would you have made payments for? You would have made payments for X and B. You would have made payments for X and B. Now add the numbers. It is 40,000 rupees of X and 80,000 rupees of B. Total becomes 1,20,000. Total becomes 1,20,000. Now, keeping this in mind, if I answer the question, notice what the number will come. I'm coming and saying, Rahul, my ATTTA is 10,000. My ATTTA is 10,000 rupees. So I will add 10,000 to ATTTA. I will add 10,000 to ATTTA. I have an ATD of 68,500 plus I will add ATC of 1,20,000. Number comes as 1,98,500. If you go and notice, you will not find an option like that. You will not find an option like that. The closest which you can find is option number C. The closest which you can find is option number C. Rahul, what is the challenge here? The challenge here, what happened is ICI has come and made an assumption that ATC is actually not 1,20,000. The ATC is 1,50,000. The ATC is 1,50,000. Rahul, how this 30,000 came? I don't exactly know, but I'm assuming what ICI has made an assumption is for policy number Y and policy number A. For policy number Y and policy number A, they come and say that the policy was issued in 2024. The policy was issued in 2024 April, which means your start of the assessment year. Now, obviously, if you're going to get a policy in 2024, the primary assumption will be that you'll make a payment first and then only get the policy. Yes or no? It's not like the policy will magically come to you and then you'll make the payment. Obviously, you would have made the payment of premium first and then only you would have got the policy in your force. And therefore, ICI has made an assumption that for policy number Y and for policy number A, the payment would have happened at least by 31st March of 2024. At least by 31st March of 2024, which falls within your previous year. Now, because that payments are also falling within your previous year, you have to take those also. Which means the assumption which ICI has made is 3 lakhs plus 2,50,000 should also be considered. Plus 2,50,000 should also be considered. Now you will come and say, me, Rahul, how does it make 30,000? Notice ATC maximum deduction you can claim is only 1,50,000. So what ICI is coming and saying is do one thing, add 40, 3 lakh, 2,50,000 and 80,000 together and restrict it to 1,50,000. Now a very wild assumption I'll come and say, because obviously, right, it's very weird for you to come and say that you have paid the premium first and then you have taken it. At least if that was the case, you should have given a clarification, right? It can so happen that you have taken the policy in 2024 and payment also could have happened on 1st April itself. Who are you to say otherwise, right? Making such wild assumption is very, very risky for all the students, especially in an MCQ scenario. It becomes very challenging, and so therefore we have also written to ICI about a clarification on this. We have requested ICI to give a clear clarification as to why you have assumed these conditions. If it was so, then you should have given a clarification accordingly. We're waiting for answers against it. Regardless of it, right now, the answer which ICI has quoted is 1,50,000 for ATC, and therefore that is what we're going to take. We're going to take 1,50,000 for ATC. Now, if you add that extra 30,000 to this number, the number becomes 2,28,500, which is what is option number C. Right? Question number 3 alone, if you have got a wrong answer, I would let it go. I would make an belief that ICI has made a mistake and it's not your fault, so therefore I will let it go. But yes, some things like these, you have to be careful. You cannot help it also, right? Question number 4. What would be the Akash's tax liability under default tax regime? Now they're coming and saying, Rahul, let's do default tax regime. Now, if I notice the question very carefully, in the next page, I only have chapter 6A, which are all not eligible under default regime, which means the only thing which I need to worry about is my incomes on the left side. Yes. So what I'm going to do is I'm going to take a page and I'm going to put the incomes on the left side and see how much my tax is going to come to. Yes. So my question is like this. I have certain slab rate incomes. I also have certain special rate incomes. I'm going to take my slab rates first. I'm going to do a total. The total is 44,50,000 plus 12 lakh rupees plus 16,000 rupees plus 45,000 rupees. Yes. So it comes as 57,11,000. So my slab rate income is 57,11,000. Now, since my slab rate income is 57,11,000, I'm going to do default tax regime, which means for the first 15 lakhs, my tax will become 1,50,000. And for the balance, 42,11,000. For the balance, 42,11,000, I will tax it at the rate of 30%, which means the number should come as 12,63,300 rupees. If I add these two numbers, my number should come as 14,53,000 13,300. 14 lakh 13,300. In this, I will now include my short-term capital gains under section 111A. In case you missed it out, please be careful about it. Oh, 1 second. Oh, it's not short term, it's long term. I'm sorry. Okay, so then it's a long term capital gains. So it's 112A. It's 112A at the rate of 10%. So it's 112A at the rate of 10%. I'm going to add that number. It is 6,54,000. So you'll reduce 1 lakh rupees because up to 1 lakh there is no tax. So 6,54,000 rupees minus 1 lakh will become 5,54,000. 5,54,000 into 10% will give you 55,400 rupees. 55,400 rupees. So add these three numbers. 14 lakh 13,300 plus 55,400 rupees. Number comes as 14 lakh 68,700. 14 lakh 68,700. This is your basic tax. This is your basic tax. In this, I will now include, in case you missed out, surcharge at the rate of 10%. Surcharge at the rate of 10%. Notice, no, the slab rate income itself is 57 lakhs. Adhik mele you have long-term capital gains also. Number is more than 50 lakhs and less than 1 crore, which means you're eligible for a LTCG, you're eligible for a surcharge at the rate of 10%. I will add that number. It comes as 146870. 146870. Number should come as 16 lakh 15,570. 570. On this, you will add a 4% cess. Your number should come as 1680,193. But since it is a tax, you have to round it off to the nearest 10. You have to round it off to the nearest 10. So number should come as 16,80,190. 16,80,190. Yes, option number B. Option number B. Question number 4, fairly straightforward. The issue is, even if, the good thing is, even if question number 3 has gone wrong for you, question number 4 will still remain right. The only one mistake which probably people would have made is either they have not given surcharge or they have not given the standard deduction. Both of this can cause a problem. Please be careful about it. Next, what will be the tax liability of Akash for 24-25 if he exercises the option of shifting out of default regime? Now, there is only one change in this. If you are going to shift out of default regime, what is going to happen, Rahul? Obviously, the slab rate will change. You already have the chapter 6A coming from question number 3. So you will reduce the slab rate income. You will reduce the chapter 6A reduction, which means the chapter 6A will become minus 2,28,500. 2,28,500. Your revised income is 57,11,000 minus 2,28,500. Number should come as 54,82,500. 54,82,500. Now on this, you are going to do normal rates because of the fact that this person is a normal citizen. He is not a senior citizen and everything. So you'll do what? For the first 10 lakh rupees, it is going to be 1,12,500. Hey, I'm doing shortcut methods. If you don't understand the method, you can do the normal slab rate formula, but keep it simple because you are doing MCQs. Let's not waste time. Yes, so for the 44,82,500, you will multiply by 30%. Number comes as 1,344,750. Add 1,12,500 to this. Number comes as 14,57,250. Again, because this person is having short-term capital gains, you have to add that number also. So 55,400 rupees. Add 55,400. Number comes as 15,12,650. On this, you will add a 10% surcharge. Number comes as 166392. 166392. No, 915. 1663,915. On this, you will add a 4% cess. Number comes as 1730472. 472. Obviously, because this is a tax liability, you have to round it off to the nearest 10, and therefore the number should come as 17,30,470, which is option number A. Yes. This is what also could be wrong, provided you have not done your chapter 6A right. provided you have not done your chapter 6A, right? Which means with question number 3 going wrong, question number 5 may have also gone wrong. Again, if you have made that right assumptions and you've got a right tax liability, then you can pat yourself on the back. Otherwise, yes, this may be a challenge. This may be a challenge, but good questions, good questions. In this question, you got tested with 2 of your amendments of the current year, which was your standard deduction being eligible for default regime, and second thing is on the life insurance policies. Yes, very good question. Please do focus on this. Now we've taken 30 minutes on this question, but yes, you have to do it a little faster. You have to do it a little faster. We had to explain and all those things. I had to write it down for you, so therefore it took some time. If it is not that you are able to complete it on time, then that is a good answer. That is a good answer. You're not supposed to waste so much time on this, because maximum, if I can look at it also, I should be able to score about yeah, fifth question should be 2 marks, fourth question should be 2 marks, so then technically it should be about 6 to 7 marks out of a question. 1.5 minutes added to that, that's almost about 10.5 minutes. So you maximum have 10.5 minutes to answer this. We have taken almost thrice of it because I was explaining to you. You should not take so much time. Yes, so please ensure that you're on pace with this. Question number 6. Mr. Anil started the business of manufacturing. Mr. Anil started the business of manufacturing tables in February 2024. He has followed a mercantile system of accounting. He has purchased goods from Mr. A, Mr. B, and Mr. C. The details of purchase and payments are given to you. Yes, so there person called Anil who is doing business. This person is following mercantile system of accounting and has purchased goods from people. He's going to make payments. Now he's made payments to A, B, and C. Let's look at what these people are so that we understand what they're talking about. First one, they're coming and saying Mr. A is micro enterprise. So which means they're now testing you on the second amendment, the MSME amendment on 43B. The MSME amendment on 43B. The MSME amendment comes and says that when you are going to make a payment to a micro enterprise or a small enterprise, when a payment is going to be made to a micro enterprise and a small enterprise, the payment has to happen within the specified terms of the agreement, which should not exceed 45 days or 15 days in case it is oral. If it is getting exceeded, then in that case the payment will get disallowed and allowed only in the year on which the actual payment is made. This is not applicable on medium enterprises. Amendment is what we are discussing. Let's look at the items. They have micro, small, and medium, which means if I look at medium itself, I can come and say this is out of scope. I can say this is out of scope. I don't have a problem with medium because medium is not even covered in the section. Yes. Next, the date of purchase is given as 15th February, 17th March, 25 March. 25 March is not relevant. Moving forward, purchase amount is 5 lakhs, 7 lakhs. The payment due date as per the return agreement is given as 30 days from the date of purchase. So for the first case, they're coming and saying, Rahul, 30 days you have to make the payment. 15th February you bought the product, 30 days you have to make the payment. Current February is a leap year period. So February will have 13 days. Which means out of 30 days, if 13 days are reduced, you have 17 days, which means March 17th you should have made the payment. Now, Rahul, when has the payment happened? It's happened on 29th March. Is it after the due date? Yes. Should it be disallowed? Yes. But when should it be allowed? It should be allowed in the year in which the payment is made. Rahul, is the payment made on current year itself? Yes. Which means technically what is happening? The disallowance will also happen in the current year. The allowance will also happen in the current year. It will offset each other and therefore there should be no disallowance. Which means this is also allowed. We did the same examples when we did the amendment class. Where I came and clarified to you that even if the payment is happening beyond the due date, but it is pertaining to the same previous year when the payment is made, it is not a problem because there will be no disallowance accordingly. It will disallow and allow in the same year itself, and therefore the net effect is 0. Coming to question number 2. Mr. B is a small enterprise. Your date of purchase is 17th March. Purchase amount is 7 lakhs. Payment is happening with no return agreement, which means when there is no return agreement, MSME Act comes and says you have to make the payment within 15 days. 17th March you bought it, 15 days would become what? It would become about 22, 32, which means almost about 2nd April. It will become 2nd April. If this person had made the payment by 2nd April, it will be allowed here itself, today itself. But the payment is happening when? It is happening on 15th April, which means it is happening after the due date. Now, if it is happening after the due date, the provisions come and say it should be disallowed in the year of accrual and allowed in the year of payment. Disallowance in the year of accrual means in the year of 23-24. Allowed in the year of payment means 24-25, which means this payment will in the current year get disallowed. Yes. Let's read the question. How much deduction would be available to Mr. Anil in 24-25 in computing the respect of purchases made in 23-24 while computing business income? Now, they don't want to know how much disallowance you're going to make. They're going to ask you how much allowance you're supposed to make, which means add the first and the last item. It is 5 plus 8, which is 13 lakhs, and therefore the answer is C. The answer is C. Now this will test you very nicely, because first thing you will maybe miss out and understand is, forget is, medium enterprises are also covered, and therefore you will disallow medium enterprises. Technically medium enterprises are not covered, and therefore there will be no disallowance on medium enterprises. That is something to be kept in mind. Other than that, the question is pretty straightforward, but a very good question which is testing you on your application skills. Please to practice this question once again if you didn't understand it. Yes. For those who still are having some doubts, please go back and look at the amendment lecture which we did in PGBP. That time in the amendment lecture, part number 1, you will find this last example where we did some illustrations and we tried to understand this very beautifully. Please take some time and do that. If not, this should suffice. This should suffice. Next. Mr. Sunil has taken an education loan of 8 lakhs on 1st July 2023 from State Bank of India, Mumbai for his son's MBA from University of Oxford. Okay. This person has also remitted the said amount through the same bank which is an authorized dealer under liberalized remittance scheme. So now what is happening is they are testing you on amendment number 3, the TCS chapter. The amendment number 3 on the TCS chapter, where they are coming and saying what will happen in case you make foreign payments. What will happen in case you will make foreign payments? As we progress, I'll tell you what are the conditions. First, they are coming and saying they have taken an education loan of 8 lakh rupees from State Bank of India for his son's MBA for University of Oxford and has remitted the same through the same bank. So from an SBI, from SBI, they have made a payment of 8 lakh rupees. Provisions come and say up to first 7 lakh rupees, there will be no TCS. Provisions say up to first 7 lakh rupees, there will be no TCS. So what I'll do is I'll split this 8 lakh rupees into 2. I'll split this 8 lakh rupees into 2. For the first 7.5 lakhs, I will say no TCS. For the first 7.5 lakhs, I'll say there will be no TCS. For the balance 0.5 lakhs, since this is an educational loan, the provisions of section 80E will also apply. The provisions of section 80E will also apply, and therefore the TCS chapter comes and says if the loan is a part of 80E, the interest rate, the TCS rate will be 0.5%. The TCS rate will be 0.5%. So therefore what will you do is, Rahul, out of the 8 lakh rupees, you will not collect any TCS on 7.5 lakh rupees. The bank will have to collect TCS on the balance 0.5 lakh rupees at the rate of 0.5%. Next. He further remitted 2 lakh rupees on 15/10/2023 to his son for his personal purposes out of his personal savings through Bank of India, Mumbai, which is also an authorized dealer. Now notice the authorized dealer has changed. In the first scenario it was SBI, in the second scenario it is Bank of India. Yes. Now in all practical sense, when I've told you TDS and TCS chapter, I've come and told you that whenever there is a TDS and TCS happening, it is between one person to another person. So it's person to person specific. It is person to person specific. In this case, if you notice, the payment is only 2 lakh rupees. The payment is only 2 lakh rupees and it is happening through a second person. Now the second person will not be aware about the first person's dealing, and therefore in all practical sense the 7 lakh will get revised. The 7 lakh will get revised, which means you will get a fresh limit. In all practical sense, I would come and say 2 lakh is not liable for TCS. Is not liable for TCS right now. Let's read the question further. Let's see what happens. Mr. Sunil has also remitted 6 lakh rupees on 28th March 2024 out of his personal savings under LRS scheme through Union Bank of India, Mumbai. Now, first person was State Bank of India, second person is Bank of India, third person is Union Bank of India. All three are different persons. Third person also, the remittance is 6 lakh rupees and it is for what? It is for sister's medical treatment. It is for sister's medical treatment. Again, fresh 7 lakh rupees, no TCS. But notice, it says Mr. Sunil has furnished undertaking containing the details of earlier remittance to Bank of India and Union Bank of India. So when Bank of India was doing payments, Bank of India was aware about SBI's payment. And when Union Bank of India is making payment, it is aware about all the further payment, all the previous payments, which means now will TCS apply? Answer is yes. Answer is yes. The second bank will come and say, you know what, since you have already exhausted the 7 lakh limit, I will now do TCS on the whole number, which means in this 2 lakhs cases, in this 2 lakhs case, you will have no other options but to collect TCS at the rate of 20%. Amendment of current year. Amendment of current year. Personal payments, amendment of current year, TCS has to be paid at the rate of 20%. Third, in the remittance of 6 lakh rupees, which is happening for medical expenditure, amendment of current year comes and says medical expenditure and educational expenditure otherwise than by loan, TCS will be at the rate of 5%. So it will become 6 lakhs at the rate of 5%. 6 lakhs at the rate of 5%, which means, Rahul, what is going to happen? 0.5 lakhs will be at the rate of 0.5%, 2 lakhs will be at the rate of 20%, and 6 lakhs will be at the rate of 5%. This is what I understand. Let's read what the question says. What is the amount of tax to be collected from Mr. Sunil in respect of the amount of remittances? The first one comes and says TCS will be at the rate of 0.5% on 1 lakh. No. TCS will be at the rate of, oh, 1 second, it's not 7.5 lakhs. Oh, yeah, it's 7 lakhs. Sorry, yeah, then it's right. The provisions of LRS is for 7 lakh rupees. It's not for 7.5 lakhs. It's 7 lakhs. I might have confused with something else. So it is 7 lakh rupees. There is no TCS. For the 1 lakh rupees, TCS is at the rate of 0.5%. So let's see. First one, it says TCS at the rate of 0.5% on 1 lakh rupees for son's education. 5% on 2 lakhs. Is 2 lakhs 5%? No. So which means option 1 is wrong. TCS is at the rate of 0.5% on 1 lakh rupees, yes. 20% in respect of 2 lakh rupees, yes. 5% in respect of 6 lakh rupees. So therefore option number B is the answer. Option number B is the answer. I will ignore the balance. I can directly proceed forward. Option number B is the right answer. I think this is the last question. Yes. Let's look at question number 8. Mr. Garg is age 45 years and is a resident of India. Is having a total income of 5,70,000. Is having a total income of 5,70,000. I'm just going to note it down. There is a total income of 5,70,000, which is comprising of long-term capital gains under section 112 of 170,000. So this has 112 of 70,000 rupees. Okay. It has a long-term capital gains of 112A also, which is 1,50,000. Which is 1,50,000. Okay. It has a short-term capital gains of 111A also. Oh my god. Of 1 lakh rupees. Okay. And the other income is 2,50,000. The other income is 2,50,000. I think we can check it also. 2,50,000, 2,50,000 and then 70. So 5 lakh, 4,50,000. Yeah. So the other income is 2,50,000. The other income is 2,50,000. The person is age 45 years. Basic exemption limit is exhausted in other income itself. You are required to compute his total tax liability for the assessment year 24-25 under default. Oh. Now they are coming and asking compute tax under default regime. Compute tax under default regime. They're not asking under alternate regime, they're asking under default regime. Now the problem with default regime is default regime, the total income can be up to 3 lakh rupees. The total income can be up to 3 lakh rupees. And the problem is your other income is only exhausting 2,50,000. The other income is only exhausting 2,50,000. Now this is one of the most trickiest things which everyone generally gets missed out. If you have missed it out also, you need to highlight it and keep it. The provisions of capital gains come and say that if at all you have not exhausted your basic exemption limit, if you have not exhausted your basic exemption limit, then the provisions come and say that you can utilize your capital gains for the purpose of exhausting your basic exemption limit, and to that extent not be taxable for it. To that extent not be taxable for it. That is a provision given in capital gains. Many people miss it out. And probably that is why the MCQ question. Very beautiful, tricky question. Provisions are default regime, number is 3 lakh rupees. Your other income is only 2,50,000, which means your capital gains can be utilized for the purpose of exhausting your basic exemption limit. Now, in this, Rahul, which one will you use? Which one will you use? Practically speaking, obviously, I would like to use what? I would like to use the income which is having the highest tax rate. The income which is having the highest tax rate, because then only my tax will come lower. My tax will come lower. Now, 112 is taxable at the rate of 20%, 112 is 10%, and 111 is 15%, which means preferable to adjust the 112 case. What I will do is, from the 70,000, I will now make the 70,000 only as 50,000. 20,000. I'll make the 112 as 20,000 because the 50,000 is going to get adjusted to my slabs. The 50,000 is going to get adjusted to my slabs, which means my slab now will become taxable at 0 for the first 3 lakhs. The slab will get taxable at the rate of 0 for the first 3 lakhs, leaving me with only 3 incomes. Leaving me with only 3 incomes, which are as follows. Now on this, I'm going to do my tax. On 20,000, my tax will be at the rate of 20%, which is going to be 4,000 rupees. On 112A, the tax will be less 1 lakh than 50,000. So minus 1 lakh at the rate of 10%. Number is going to be 50,000 into 10% is going to give you 5,000. Then 1 lakh at the rate of 15%. 1 lakh at the rate of 15%. Number is going to be 15,000. Number is going to be 15,000. Add the numbers. It is 15, 20, 24,000. It is 24,000. Now, for those who are hurrying and going to decide to add cess on this, answer is no. Answer is no. Please understand, you are in default regime. Current year default regime has taken a radical change. The change in the sense that default regime in the current year comes and says that for the first 7 lakh rupees, you will not get any kind of tax because you are eligible for a rebate of 25,000. You are eligible for a rebate of 25,000. Yes. But Please also remember the fact that rebates are never eligible on 1128 taxes. Rebates are never eligible on 1128 taxes. 1128 has to be paid and you will not get any rebates on it. You will not get any rebates on it. Look at the question. In the question, what is happening is the total tax is 24, which may be less than 25, and therefore you'll come and say your tax is 0. But unfortunately, you also have a 1128. You also have a 112A, so you cannot claim rebate on this 112A. You cannot claim rebate on this 112A. You will only get rebate on this 15 plus 4, which means you will be claiming a rebate of 87A on 19,000. On 19,000, you will get a tax of 5,000, and on this 5,000, you mandatory have to pay taxes. Add 4% cess, number becomes 5,200. Number becomes 5,200. When we started the batch, first rates of taxes, we have done hundreds of questions on this. We have done hundreds of questions on this, where we again and again clarified the fact that you will not be eligible for any rebate when it comes to 112A incomes, and therefore that has to be mandatory pay tax, which means the answer to your question number 8 will become option number B. The answer to your question number 8 will become option number B. A very beautiful question, which is tackling your amendments of the current year, checking for your unexhausted basic exemption limit, and also giving you a touch upon the rebate not being eligible on 112A. Very beautiful question. Very beautiful question. Please keep this question intact. If you have not been able to get the right answer on this question, wherever you have made a mistake, please go to your concept guides once again and put a bold highlight on all these adjustments. Put a bold highlight on all these adjustments. Some of these adjustments are very, very critical for your exam purposes and keep coming in every MCQs. Keep coming in every MCQs. If you notice, the option of nil is also there. You would have made a clean cut mistake on the option of nil, and answer would have gone wrong there itself. Answer would have gone wrong there itself. You have to be very, very, very careful about all these things. Yes, please make a note of this and keep it intact, so that when you go for your exams, the day before exams, if you see this adjustment, it should flash on your head saying that yes, I made a mistake on this and I will correct it in my exams if at all it comes to me. Please keep that in mind. Yes, so option number B is the right answer for question number 8, which is what I'm assuming. So yes, great. Yes, now the balance questions I will not discuss it with you. I think it's fairly straightforward, simple questions. Question number 9 is all about computing the residential status and scope of total income. You should be able to solve it. I've seen the question, it's fairly easy. You have the next question, which is talking about your house property. Yes, so it looks like a house property question to me. You have some municipal taxes paid, you have taken a loan, you have then purchased some property, the stamp duty value of the property is given to you, you have purchased a property, land also. Technically, you're going to do some capital gains also, and you're going to do some IFOs also. Yes, a fairly good question. Please do practice it. You have salary income also, whatever. Yes, then you have residential house. Now, this is your clean classic capital gains question, where they're checking for your immovable property sales. We have done so many questions on this, and I've told you that when it comes to immovable property for capital gains, that's a very important adjustment. Very beautiful question. Please do solve it once again. I personally felt it to be a very easy question, so I don't see any complications on this question. There was no much exemptions also to worry about. Yes, some straightforward exemptions were given to you. Very easy question. Then you have question number 12, which is about partnership. Oh wow, partnership and all generally does not come, but this is very interesting. They have given you a partnership level question, so please do look at this partnership level question. Oh, along with adjustments. Okay, so they've given you a partnership question with adjustments, which means you have to do partnership firm order total income. Please do that. Then last question is Rahul, Indian resident, files his return of income, Aadhaar number. Okay, Aadhaar order amendment question. They've given the amendment question relating to Aadhaar. We have current year amendment in Aadhaar, no? Where if you don't link your PAN with Aadhaar, you will have some consequences on all. So theory question. And yeah, yes. So the other questions are fairly straightforward, but it will give you a good practice on what the questions is. It looks a little tricky, but it will actually test you on your knowledge. You should definitely try these questions. Yes, the intention of RTPs in every exam is this only, to see that if you are able to practically apply all your theoretical topics. As such, the questions relating to RTP are not very tested. Because these are all challenging level questions, but that does not mean that this will be a good practice for you. Please do practice these questions, because it can give you a good insight on how your preparation strategy is going on. And if there is any challenges, please do make a note of these in the concept guides and keep yourself updated to that. Yes, that's it from my side. Signing off today. I will come back with some more videos for you to enjoy and appraise your income tax loss for your exams. See you everyone.